In this video, I'm going to reveal the simple but powerful investing basics that most beginners ignore. By the end, you'll understand exactly how the stock market works, as well as how to avoid expensive mistakes, and you'll even learn easy, stress-free strategies to grow your money steadily. So this is my second video about the basics of the stock market. In the first video, we discussed why investing in stocks is a smart move, how to get started even with a small budget, and we also talked about different investment styles and which one suits you best. So let's get it. Let's dive in. So first and foremost, let's talk about what is a stock exchange. So think about a stock exchange as a giant marketplace, but instead of fruits and clothes and all the things, you're trading ownership that comes with shares of companies. It's an organized system designed to make sure the trading is fair, the trading is safe, and the trading is transparent. The stock exchange acts as the trusted middleman to make sure nobody gets cheated. So here's a quick and easy overview of the major stock exchanges that are around the world. So first and foremost, we got the behemoth, right? Which is the New York Stock Exchange. It's located on Wall Street. It was established in 1792, and the New York Stock Exchange is literally the oldest and largest stock exchange. It's the home to big stable companies like Apple, Coca-Cola, Walmart, JP Morgan Chase, and what people often call blue chip companies, meaning they're reliable and steady over the long haul. So, unlike fully digital exchanges, the New York Stock Exchange still has a physical trading floor where brokers buy and sell stocks face to face. And they use kind of this auction style system. Major indices like the Dow Jones, the S&P 500 track many of these New York Stock Exchange companies to show their overarching market trends. Now, next we got the NASDAQ. So NASDAQ was established in 1971. It was truly the world's first electronic stock exchange. It's best known for its tech listings like Tesla, Amazon, Microsoft, Google. Trading here is entirely digital, making it easy and more efficient. So the NASDAQ attracts high-quality growth, innovative companies, often making it more volatile compared to New York Stock Exchange. The NASDAQ tracks thousands of these companies, mainly from tech and the biotech industries. Now, let's go abroad. We also have the London Stock Exchange. It was founded in 1801. It is one of the world's oldest exchanges. It connects investors globally and hosts many international corporations like British Petroleum, Unilever, HSBC, and GlaxoSmithKline. So think about the London Stock Exchange as a global crossroads where companies from around the world come together. Now, we also have the Tokyo Stock Exchange. Now, this stock exchange was established in 1878. It is the largest in Japan and is a central player in Asia. It lists major Japanese companies like Toyota, Sony, Honda, Mitsubishi, and SoftBank. The Nikkei 2000, their index tracks 225 top companies, giving investors a snapshot of Japan's economy. Companies on the TSC are divided into categories like prime markets, standard markets, and growth markets as well. Now we also have the Shanghai Stock Exchange. It is China's stock exchange. It was established in 1990, which is really young, and has quickly become an important global market. It is major Chinese corporations like Alibaba, PetroChina, ICBC, and China Mobile. The Shanghai Composite Index tracks all companies on the exchange, offering a clear picture of China's economy. SSE has two types of shares: A shares, which is traded in Chinese currency, mainly for local investors, as well as B shares, which is traded in foreign currencies, and that's accessible to international investors. So think of it as like having entrances into the same market, one for locals and then also one for international buyers. So understanding these exchanges can help you to navigate the investment world comfortably, like knowing different cities and different neighborhoods in the states here in the U.S. Each has its own personality, opportunities, as well as its own risk, but knowing them makes decisions smarter as well as easier. But there's one more fundamental thing that you need to know that can impact your investing journey, and that's market hours. All right, when you know when these bad boys are open. All right. So the stock market is not open 24/7 like an online store. The U.S. stock market hours are from 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday through Friday. But did you know that there's also pre-market and after-hours trading as well? Those hours for pre-market from 4 a.m. to 9:30 a.m. Eastern Standard Time. After hours is 4 p.m. to 8 p.m. Eastern Standard Time. But your location definitely matters. So if you're on the West Coast, the market hours will actually start at 6:30 a.m. And if you're in a country like India, then the U.S. markets are open late at night, okay? Time zones impact when you can trade as well. And for global investors, it's crucial to plan accordingly. But how do you take the first step? So first and foremost, it is important that you practice with paper trading first. This will allow you, before you jump right in, to get some practice. It's just like learning to drive safely before hitting the highways. So that's exactly where paper trading comes in handy. Paper trading is like a stock market simulation where you pretend to make real trades. It's safe and it's stress-free, and it's a way to help you learn how to understand how the market works. So try out trading strategies without risking your real money. Build your confidence first, right, before you use your actual cash. Many brokers like Charles Schwab, TradingView, and Webull offer free paper trading accounts. So think of paper trading like kind of get your training wheels when you ride a bike, right? It allows you to practice safely, learn from your mistakes, and become comfortable before taking off on your own. So if you're new to trading, start practicing with paper trading first. That is key, all right? And then once you build up some experience with paper trading and you start to feel confident in your strategy, the next step is to use your live account inside of your brokerage. This is a crucial gateway, right, to actual trading. So let's talk about some of the steps that you need, okay? First and foremost, we need to start researching platforms that best meet your needs. Look for brokers who have low fees, intuitive interfaces, and comprehensive educational resources. Many beginners like platforms like Robinhood, Fidelity, or E-Trade, especially because they're user-friendly design and their supportive learning materials. So after selecting a broker, you need to sign up by providing some basic personal information. So this typically involves like filling out an online application, verifying your identity, and often uploading some type of form of identification as well. They're going to ask for some personal information, so get ready, all right? But this step is crucial because it ensures the security and legitimacy of your trading account. Once your identity is verified, you also need to deposit funds into your account. Most brokers are going to offer various funding options such as bank transfers, debit cards, or even PayPal for some of them. So think of this as the stock market really trying to equip you with all the capital necessary for you to start trading. So you'll also need to decide between a cash account as well as a margin account. A cash account means that you trade only with the money that you have, whereas a margin account allows you to borrow funds for trading. Each option has its benefits as well as its risks, so choose the one that best fits your comfort level as well as your financial goals. Once your brokerage account is set up and funded, you are literally ready to make a move into real trading. However, if you still feel uncertain, listen, all right? You can always return to paper trading, all right? This is a way to practice without the risk. So before you head into real investing or real trading, make sure you also learn some key stock market terms, all right? We have to be able to speak stock market. So let's talk about some. First and foremost, we can start with bid and ask. So the bid is the price that buyers are willing to pay, whereas the ask is the price that sellers want. The difference between the two is called the spread. Now, we also have bull markets and bear markets. A bull market is when prices are rising and everybody's happy. The sun is shining, right? A bear market is when prices are falling, and that's when investors can get a little nervous. Let's now talk about market cap. A market cap tells us what the company's total value is, okay? A large cap company means that they're making good money, they're pretty valuable. We can also talk about the open and the close of a stock as well. The open price is what the price of the company opened that particular day. The close price is where it closed that particular day. That's really important to understand when you are trading on the stock market. So now that you're getting comfortable with practicing and trading, and also you understand some common stock market terms, let's dive a little bit deeper into how trades actually work. So that's where understanding order types comes in, all right? So first and foremost, we want to know if we are doing a market order or a limit order, okay? So let's talk about a market order first. So a market order is literally the quickest way to trade, okay? It means that we can actually get in immediately at the best available price. So it's like grabbing an item straight off the shelf without checking for discounts, all right? You'll get it quickly, but the exact price may vary a little bit, right? That is if price changes fast, all right? So an example of that is that, like Apple. So if you buy Apple for around $150, you place a market order, you'll likely get in around close to $150, but not exact, depending on how the market's moving in that moment, okay? So now let's talk about a limit order. A limit order lets you specify exactly what price that you want to buy or you want to sell at, all right? So here's an example. So let's say that if Boeing is currently trading at $200, you might think that's a little bit too expensive. So you can set a limit order at maybe $180, and your trade won't execute unless it actually reaches that $180 price or lower, giving you complete control over how you get in, okay? So now let's talk about a stop order. That is when you have a stop order will allow you to wait until the stock hits a particular price before turning into a market order, okay? So an example of this is that Amazon stock was surged after hitting 3,500, which was a long time ago, all right? It ain't there now, right? After it split. That's why it's lower. But a stop order allows you to execute at the current market price, all right? A stop loss order also is like a safety net. This type of order protects you from big losses. It automatically sells your stock if it falls at a certain price. It's kind of like wearing a seatbelt while driving. It's there to protect you just in case things go wrong, okay? So for example, let's say you bought Google shares, but want protection in case the prices fall. So you can set a stop loss order at a specific price. If the price ever dips below that, then your shares will sell automatically, which helps you to prevent even bigger losses as well as locking your profits. So knowing these order types is essential because they help you to trade smarter, minimize your risk, and keep you in control of your money. So now that you know how to place trades, let's talk strategy. So here's one simple practical tip that'll help you invest smarter right from day one. So first things first, how much should you invest? So the golden rule is never invest money that you cannot afford to lose. Listen, all right? Start small. There is no need to invest a large sum right away. Many brokers now offer something called fractional shares, allowing you to start investing with just $10. This approach helps you to learn the market without risking a substantial amount of money. So realistically, $50 to $100 can get you started, but it always helps to have a little bit more. Also, invest consistently. Use strategies like dollar cost averaging, which is investing a fixed amount every single month. We'll talk about that in a little bit later. Also, diversifying your portfolio. Diversification is essential to reduce your risk, okay? Investing in a variety of stocks is really helpful for you, okay? Because that allows you, if one thing goes south, then you have some other stocks that can hold up your portfolio. Also, think long term. The stock market is inherently unpredictable, okay, in the short term, right? But focus on long-term growth rather than chasing quick gains, all right? Especially if you don't have a strategy. Many successful investors have built their wealth gradually over time through disciplined long-term strategies. So keep learning, stick to a plan. The market is constantly evolving, so it is important to stay informed by following financial news and studying market trends. A clear, well thought out plan that matches your risk tolerance and financial goals will help you to avoid impulsive decisions. And if you're considering a new strategy, test it first through paper trading before you use your real funds. Even after knowing all of this, you might still have one question in mind. Is investing risky? So yes, it is. It comes with risks, right? But you can absolutely manage them. So think of it like this. Not all investments are created equal. If you're interested in low risk, you've got things like index funds and exchange traded funds. There's slow and steady ways of investing, okay? If you want like medium risk, that's cool too. That's when you have blue chip stocks, stable companies that have been around the block, been there, done that, got the ankle socks and everything, all right? If you're interested in higher risk, then we're talking about penny stocks and crypto. Listen, they can be a little bit unpredictable, okay? So be careful out there in them crypto streets, all right? So don't be out there trading crazy, all right? So how do you reduce your risk? Be sure to do your homework, okay? Know what you're investing in before you put your money at play. Set stop loss orders. It's like setting boundaries. You tell the broker, if it drops too much, get me up out of here, all right? Play the long game. The market goes up and it goes down and it trades sideways. Don't panic though with every single dip. Think years, not days. And the bottom line, you can't erase risk, but you can get smart about how you handle it. So now that you're getting the hang of investing, let's explore some simple yet powerful investment strategies that can help you grow your money safely as well as effectively. So first and foremost, dollar cost averaging. It is the steady investor's best friend. Dollar cost averaging is all about consistency. Instead of trying to perfectly time your investments, you get regularly fixed amount of money over a long period. So think of dollar cost averaging like watering a plant. Small, consistent amounts keep it healthy over time. So why is this smart? DCA reduces your risk because you buy stocks at different prices, smoothing out market highs as well as market lows. For example, instead of investing a lump sum of $10,000 at once, you invest $500 every single month. Sometimes you'll buy stocks at lower prices, sometimes higher, but overall you average out your costs, reducing the risk of poor market timing. Index fund investing means buying a fund that tracks a large group of stocks, such as the S&P 500, which includes the top 500 U.S. companies. It's like buying a ready-made basket of the strongest, most stable companies in one single investment. So why is this smart? Because historically index funds offer steady, reliable returns with low fees. It's ideal for beginners who don't have time or the experience to research individual companies. Instead of researching individual stocks like Apple or Microsoft, you can buy an S&P index fund. This automatically gives you a small piece of each of these top performing companies, offering broad market exposure without the stress. Then we also have something called dividend investing. Now this is kind of like getting paid to wait, right? Dividend investing involves buying shares in companies that regularly pay a portion of their profits directly to shareholders as cash dividends. So think of it like owning a rental property. You hold onto the asset and it pays you regular income. So why is this strategy smart? Because even if the stock prices fall, dividend paying companies provide steady income, helping to stabilize your portfolio in volatile times. For example, if you own 100 shares of Coca-Cola, which pays a dividend around $2 per share every year, then that means you can earn $200 annually just for holding those shares. So over time, these dividends can be reinvested to grow your wealth further through compound interest. Growth investing focuses on buying shares of companies that have potential to grow rapidly, usually due to innovative products, technologies, or market dominance. So imagine finding the next Netflix or Amazon early on. These companies often grow quickly as well as dramatically. So why is this smart? If chosen wisely, growth stocks can significantly boost your portfolio's value. However, remember, higher rewards come with higher risk. Early investors in Tesla believed in its potential long before electric cars went mainstream. Those who bought early saw huge returns as Tesla grew from a small startup to a global powerhouse. Growth investing is exciting but requires careful research as well as patience. So, now that you have the essential toolkit, you can practice safely with paper trading, okay? You know how to open and manage a brokerage account. You understand key order types to control your trades. You have beginner-friendly strategies like dollar cost averaging, index funds, dividend investing, growth investing to build your wealth safely and steadily. The key to success is patience, consistency, and clear understanding. Exactly what you've been building right here. So, if you found this video helpful, be sure to hit that like button and subscribe for more investing tips. Also, drop a comment below. What's your biggest challenge when it comes to investing or trading? I would love to know that, all right? I look forward to seeing you in the next video. Happy investing!